At 11:47 p.m. Eastern on Thursday night, the silver market blinked, not on a chart, in a vault. A withdrawal ticket surfaced from Shanghai. 300 kilos marked out, released, gone. Then the flood started. More slips, more vaults, more weights. Same direction. Physical silver was leaving China fast enough to make the paper price look like a joke. By Friday morning, December 27th, 2025, Shanghai was trading near $82 an ounce. New York paper was still printing around 79 and change. That gap is not shipping, it's not tax, it's not noise. That gap is the physical world telling the paper system, you're not in charge anymore. And if you think this is just another rally, you're missing the main event. Because what happened this week wasn't a spike, it was a decision. China began pulling real metal inward while the West kept quoting a paper number. Now we have to ask the only question that matters. When the world's biggest industrial buyer stops exporting the stuff everyone else depends on, who gets left holding promises? I'm going to walk you through what likely happened behind those withdrawal slips, why the spread refuses to close, how the deliverable pool in New York is thinning, and why the next 30 days decide whether the paper benchmark survives or gets replaced by the physical price in the East. Stay with me, because the next layer is where this turns from interesting into unstoppable. First, understand the rule of a normal market. If Shanghai pays more than New York, traders buy cheap metal in the West, ship it east, and sell higher. That's arbitrage. That's the pressure valve. That's the mechanism that keeps one global price. So if the gap is still there, one of two things is true. Either shipping is impossible, or metal is scarce, and shipping isn't impossible. It's just expensive. Scarcity is the real culprit. Scarcity is what breaks the bridge. Now, let's get specific about what those slips likely represent, because this is where the story turns dangerous. A vault withdrawal isn't a meme trade. It's logistics, scheduling, and a destination ready before the bar even left the pallet. That kind of movement usually comes from three categories of buyers. Industrial users building inventory ahead of a choke point, large trading houses fulfilling off-exchange contracts that can't be delayed, or state-aligned entities converting paper exposure into physical stockpiles. Any of those is bullish. Two of those are explosive. Retail might sell if price spikes. Factories don't take profit. They consume. Sovereign buyers don't flip metal. They lock it away. That's why the reaction matters more than the screenshots. Shanghai didn't dump after the slips. It held firm. That tells you supply didn't return. It tightened. Now think about timing. Year-end is when supply chains rebalance, budgets reset, quotas roll, and shipping clogs. If export approvals tighten right as the West enters a new delivery cycle, you get a perfect storm. Western paper holders roll contracts assuming bars can be sourced later. Eastern buyers pay up for immediate metal. The gap widens. Arbitrage fails, and the market starts asking the question it hates. What if I stand for delivery and the answer is cash? Because once that question enters the room, confidence starts bleeding out, and confidence is the real inventory in a paper market. Now picture the next domino. If even a small percentage of futures longs decide to test the system just to see, registered metal gets stressed. The exchange can survive low delivery demands. It cannot survive curiosity. Curiosity spreads. One fund stands, another stands, then a third. Not because they need bars, but because they don't want to be last. That's how benchmarks die, not with fireworks. With a quiet moment when buyers realize the product they bought isn't the product they thought. So here's the cliffhanger to sit with. The market has not yet had its proof week, the week when delivery requests, premiums, and policy headlines collide at once. If that week hits in January, you won't need screenshots. You'll see it in the spread that refuses to close no matter how loud paper price screams. And the world will notice. You don't get persistent multi-dollar premiums in a market swimming in bars. You get them when buyers are panicking and sellers are rationing. Now rewind 6 months. Back in June 2025, silver looked sleepy. COMEX traded in the low 50s. Shanghai carried a small premium, the usual friction. Everything felt synchronized, predictable, boring. That's what the system wants, boredom. Because boredom keeps people from asking where the bars are. But late September, behavior changed. Not retail behavior, industrial behavior. Chinese dealers started reporting a strange pattern. Manufacturers were buying early, buying big, buying without haggling. Solar supply chain orders moved forward. Electronics firms started padding inventories. It looked like someone with real authority had warned them, supply is about to tighten, and you will not be allowed to scramble later. At first, analysts dismissed it. Seasonality, quarter end, holiday build, routine. Except it didn't stop. It accelerated. Visible exchange inventories on the Chinese side began sliding beneath their comfort range, not with chaotic jumps like speculation, with steady erosion like consumption. Then the rumor hit, a licensing wall, a new export approval gate, Fewer firms allowed to ship silver out, more paperwork, more state control. Most people called it paranoia, until the message turned official. China signaled that exports would be restricted under a tighter approval regime starting at the turn of the year. Whether you call it a ban or a gate, the result is the same. Supply leaving the country becomes political, not just commercial. And that matters because China isn't just a participant in silver. China is a choke point. Here's the uncomfortable truth of the modern silver pipeline. A huge portion of the world's mined silver doesn't become clean deliverable bars where it's dug up. It comes out as concentrate, mixed with other metals, often as a byproduct. It has to be processed, refined, and converted into standardized forms that industry can actually use. Over decades, the world built a system where a massive share of that processing capacity lives in China, which means a lot of global silver flow passes through Chinese hands before it becomes the kind of metal that settles contracts and feeds factories. So when China tightens the gate, the rest of the world doesn't just lose Chinese silver, and it risks losing the processing pathway that turns raw material into usable metal. Now imagine you're a procurement manager. You're not trading a chart. You're trying to keep a production line alive. If you build solar panels, silver paste isn't optional. If you build high reliability electronics, silver contacts aren't a luxury. If you build power systems, silver isn't a fashion statement. You either have it, or your line slows, or your line stops. So the moment the gate tightens, every serious buyer makes the same move. Front load purchases, lock contracts, overbuy if you have to. Because the cheapest silver is the silver that is still available. That's why Shanghai didn't drift higher, it stepped higher. And here's the part the headline number hides. The screen price is polite. The immediate delivery price is brutal. When a market is tight, dealers stop talking about spot and start talking about availability. Available today costs more than available next month. And that is exactly what a shortage looks like before it becomes public. Premiums creep in first, delivery times stretch second. Then the shelves go empty. Now, let's talk about the Western Vault story, because this is where the illusion thrives. New York's system reports inventory in two buckets. People confuse constantly eligible and registered. Eligible metal is stored in approved warehouses, meets standards, but is not committed for delivery. It belongs to someone. It's sitting there. It's not necessarily for sale. Registered metal is the deliverable pool. That's the metal that can be used to satisfy futures contracts when someone stands for delivery. That's the metal that matters when confidence gets tested. Here's why this distinction becomes lethal in a stress event. A big total inventory number can look comforting while the deliverable number is shrinking underneath. And deliverable is what counts when paper holders stop rolling and start demanding bars. If registered inventory drops, the exchange can still function as long as nobody asks for too much at once. But when fear rises, people ask. They always ask. And when enough people ask at once, the market discovers whether it's a real bridge or a painted tunnel. Now add the next detail. Reclassification. Metal can move from registered to eligible. A vault operator can decide, this bar is no longer available for delivery, it's being held. On paper, total metal doesn't vanish, but the deliverable pool does. That's how a system buys time. And buying time is what you do when you're tight. Because rule changes don't create silver. A margin hike can liquidate speculators, it cannot manufacture ounces. A trading halt can freeze a chart. It cannot freeze industrial demand. So if physical scarcity is the driver, paper tools lose power. And when paper tools lose power, price discovery migrates. That's why the Shanghai premium matters so much. It's not just a number, it's a vote. A vote for the physical clearing price. A vote against paper comfort. Now, let's address the lazy argument you're going to hear everywhere. We've seen squeezes before. Yes, and most ended badly. Everyone knows the story. So skeptics say this will end the same way. But the driver is different, and the driver is everything. In past episodes, leveraged speculators played a huge role. Leverage makes a rally fragile. Change the rules, raise margins, and leveraged players are forced to sell. Forced selling kills momentum. But a sovereign industrial buyer doesn't behave like a leveraged speculator. A manufacturer buying for continuity doesn't behave like a hedge fund chasing a spread. Industrial demand is not a trade, it's a requirement. And requirement demand is inelastic. That phrase is the monster under the bed. Inelastic demand means price doesn't stop the buying until price is absurd. Because the cost of not buying is worse than paying up. If silver rises $5, the cost per device for many products barely moves. But if silver isn't available, the product can't ship. Missed shipments aren't a rounding error. They're a crisis. So the industrial bid becomes a rising floor. Every dip gets bought, not because it's cheap, but because it's there. And that's how a market shifts from speculative to structural. Now look at what the spread is saying. If Shanghai is paying 82 while New York prints 79, it means the physical market is clearing higher than the paper market. If the system were healthy, that spread would close quickly. So why doesn't it? Because the arbitrage chain is constrained. Because the metal that would normally flow to close the gap is already spoken for, already held, already being pulled inward. Because the cost of sourcing has risen faster than the paper market is admitting. And that's where we land on the next 30 days. The next 30 days are the pressure test. Policy deadlines compress behavior. Year-end planning compresses behavior. Budget resets compress behavior. Factories don't wait for CNBC to tell them what to do. They buy before the constraint bites. So as the calendar turns, you should expect a simple sequence. First, more pre-buying. Second, more premium. Third, more inventory stress. Then either the paper market chases or it fractures. And fracture doesn't look like a dramatic explosion on a single day. It looks like little failures, cash settlements encouraged, delivery delays, strange category shifts, sudden inventory that can't actually be mobilized. At some point, the market stops asking, what's the paper price? And starts asking, what's the delivered price? And delivered price is what Shanghai has been telegraphing. Now, let's talk about Monday, because Monday is where psychology meets mechanics. Weekend silence is deceptive. While Western desks are closed, information travels. Procurement teams update plans. Funds read the spread and realize the East is leading. Short sellers sweat. And when Asia opens, the first print becomes a signal. If Shanghai opens firm again, it tells the world the bid is real and persistent. If New York opens and gaps up to reduce the spread, it confirms the chase. If New York opens flat while Shanghai is higher, it confirms the fracture is widening. That's the setup. Now add the accelerant, shorts. Every strong rally creates shorts who think this is overextended. They sell, expecting a pullback. Sometimes they're right. But in a tightening physical market, being short is like holding a lit match in a dry forest. Because if price pushes higher and stays there, shorts must cover. Covering is buying. Buying drives price higher. Higher price forces more covering. That feedback loop is the squeeze. And squeezes don't ask permission. They punish hesitation. So where could this go? In a normal commodity, you'd model demand, model supply, and assume price self-corrects. But in a policy-constrained environment, the model breaks, because supply becomes gated. And gated supply behaves like a dam. Water can be calm behind it until the pressure builds enough, then the release is violent. That's what premiums are, pressure. That's what withdrawals are, pressure. That's what restrictions are, pressure. Now zoom out to the demand landscape that makes this dangerous. Solar is not slowing, electronics is not stopping. Grid upgrades are not a fad. Electrification is not a marketing slogan anymore, it's a mandate. And silver is a core input across those systems. It's used in tiny amounts per unit, but in enormous numbers of units, which means silver gets dispersed. And dispersed silver is hard to recycle economically. So a lot of silver demand is effectively destructive. It doesn't come back quickly. It's locked away inside products for years or lost in places nobody will recover. That makes above ground inventories the real buffer. And those buffers are not infinite. They are the reservoir. When the reservoir drains, price has to ration. Now look at the geopolitical angle. If one side of the world decides to secure metal and keep it domestic, the global float shrinks. Less float means more volatility. More volatility triggers more hoarding. More hoarding shrinks float further. That loop doesn't require retail mania to run. It runs on institutional risk management, and that's the kind of loop that turns a premium into a new pricing regime. Now, I need you to see the trap most people fall into. They wait for certainty. They want the perfect entry. They want confirmation. But in real shortages, confirmation arrives after the shelves are thinner, after premiums are larger, after delivery windows are longer. Certainty is always the most expensive thing in the market. So instead of waiting for a headline to bless you, watch the physical signals. Premiums, delivery times, inventory category shifts, withdrawal patterns. Those are the early warnings. Now, let me give you 2 questions to drop in the comments, because your on-the-ground data beats any studio analyst. Are dealers where you live charging higher premiums than a month ago? And do you think the paper benchmark will chase the East, or will it try to change rules to slow the move? Now, quick and simple, if you want the next update when it drops, subscribe. Short, effective, no fluff. Because the next phase won't be announced with a press conference. It will be announced with out of stock, with spreads that refuse to close, and with policy language that suddenly gets very serious. Here's what I'm watching next week. 1, the Shanghai premium. If it stays elevated, the physical clearing price is asserting itself. 2, deliverable inventory behavior in New York. Not the total headline number, the deliverable pool. 3, any sign of market management. Position limits, margin shifts, settlement incentives. Those are stress signals, and now the cliffhanger. If the East keeps bidding higher, the West has only 2 choices. Chase the price, or change the rules. Chasing admits scarcity. Rule changes admit fragility. Either way, it's an admission. So watch the next move closely, because the next move tells you what the system fears. The paper system can print contracts. It can print promises. It can print narratives, but it cannot print ounces. And in the end, the market doesn't care what the narrative is. The market cares who has the metal. That's why those withdrawal slips mattered. And they weren't just posts, they were signals. Signals that physical silver is being pulled out of circulation into the hands of buyers who intend to keep it. And once the metal is held, it stops being liquidity. It becomes scarcity. If you've been waiting for the moment when the silver story turns from theory into reality, this week was your warning shot. The next 30 days decide the verdict. So keep your eyes on the spread, not the noise. Keep your eyes on inventory, not the hype. Keep your eyes on policy, not the pundits. And tell me in the comments, do you think this ends with a quiet chase higher or a loud rule change? Because whichever one happens first will tell you where the real power sits now. And remember, the physical market doesn't lie. It just runs out.